Welcome back, everybody, to another episode of Alt Reports Radio, where today I'm on here with Jamie Bateman of Labrador Lending. Jamie, thanks for jumping on here today. You were referred by my good friend Brett Berkey, who owns PaperStack, and
Yep,
he thought that with what I'm trying to do over here, that you and I should chat, and I'm happy to have you on here. Tell us a little bit
absolutely.
about who you are and what you do.
Yeah, thanks a lot, Breck. I really appreciate you having me on. And thanks to Brett for hooking us up. Yeah, so Jamie Bateman, I am a husband, father, small business owner, military veteran. I'm used to be a college athlete, used to be an athlete, period. We don't
Me
have to
too.
talk about how we don't have to talk about how I injured myself playing
Oh,
badminton, but I am primarily a mortgage note investor right now. I have a small team, and we manage a couple of note funds. I have a background in real estate, residential real estate in particular. My wife and I have a portfolio of single family rentals, and I used to years ago worked at a title company and a mortgage broker company as well, and realized how little I knew about that entire space. And so I didn't know at the time that that would be helpful now for me and my team and
hmm.
our investors. And but um, since 2015 is when my wife and I really kind of got very serious about single family rentals, and we were doing the Burr method and rehabbing properties and
What's the
you
Burr
know
method in case folks
ref-
don't haven't heard that?
sure. Yeah, absolutely. So we had started years prior with rentals, but then we got heavily into it in 2015. But the Burr method is you buy a distressed property or buy a property, rehab the property, um, rent the property out, find a tenant, and then refinance the property. So either you're buying with cash or you're buying with private money with not so great terms or hard money. And then you're eventually, once you get that tenant in there and you show a little bit of income to a bank or a more traditional lender, then you hopefully can refinance the property. So, just to kind of maybe give it a quick example, put a little bit of numbers behind it. We were actually initially starting with cash, and we would buy a property, say for 150, maybe put 25 grand into it, and then get a tenant, put the tenants in there, and then refinance the property and get our cash back, or at least most of our cash back, and then go do it again. So the final R is
Nice.
repeat on Burr. I didn't create that
Yeah.
acronym, but a lot of people have done well with that method. And so we were doing that for quite some time. And then in 2018 is when I pivoted more over to mortgage notes.
So how did that happen?
Yeah, so we kept the rentals. We haven't sold one. It's and we've continued to grow the rental portfolio as well. But um, I think it was mostly through podcasts, Bigger Pockets and reading forums and just learning. And to be honest, part of it was, okay, I get the rental thing now. I
Yeah.
mean, not that I'm the world's leading expert on rentals, but we were buying essentially the same property over and over. And you get a little, I'm sure you can appreciate as an entrepreneur,
Yeah.
you get a little bit bored.
Sure.
And so I said, what's this mortgage note thing? And started researching. I was comparing tax lien investing and mortgage note investing at the time.
Hmm.
They seemed somewhat similar, and there are a lot of benefits to mortgage note investing that I found out about. There's no perfect asset class or strategy out there. At least I haven't found one yet. But
Yeah.
so every asset class and every strategy has drawbacks. But I started digging into mortgage notes for a variety of reasons. You can do it from anywhere. If you have a laptop and a phone, you can be a mortgage note investor, and
Yep.
so that's one of the perks that I saw right away, and started digging into it more, and realized I really like this space, so I want to dive into this. And so for the last 4.5 years plus, mortgage note investing has been my primary focus from a professional standpoint.
Okay. And so what was that first deal like?
First deal. Yeah.
Yeah.
So first deal, I in one week I kind of had two different deals I went into at the same time. One was a joint venture with a gentleman named Chris 70. We're now business partners on. We have a loan servicing company now called BuyFi, and then we also started a note fund together. So obviously, our relationship grew over the last 4.5 years.
Yeah, must have been a good
But
note.
the first deal was a joint venture. What's that?
Must have been a good note.
Yeah, exactly. Well, it's
Grew this whole relationship out of it.
we ended up doing a podcast episode on that note. If if your listeners get really interested, it's called Nightmare on Elm Street. So
Oh,
it had
we'll link
every
to
note
it.
has a story, and this one had quite the story to it. We did make money on it, but truthfully, my intent, obviously, I want to get want to make money, right? But my intent was more to um, develop my own knowledge of the note space and also expand my network. And that is what started to happen. So essentially, with that joint venture, I was the money partner, and Chris was kind of the day-to-day manager of it. And I also that same week funded another deal that was more of a uh, passive deal per se, where it's a 5-year interest only loan. But that one, I'm out of both deals at this point. So it just kind of slowly grew over 2018 as far as my own knowledge and activity related
Yeah.
to mortgage note investing. And, you know, now managing a couple of funds, and it's a fun space to be in. There's a lot to learn, but I enjoy it.
So one of the things in the note business, I guess the main thing, if you're especially if you're just starting out, I mean, one way is you go and you invest in a fund with folks like you, but the
Yep.
the deal sourcing, where are you
Yes.
sourcing your deals from? Because I mean, that's really what it's all about, right? Is you need to find them and
Yeah.
before anything else happens. So what's that look like?
Great question. I think it's the number one challenge.
Yeah,
And I think so. The way I view it, and I certainly didn't come up with this, but I've heard more experienced investors use this framework. I know, like Dave Van Horn, for example, will talk
yeah,
about this. But your business comes down, if you decide to get into notes as a business, it really comes down to three things. One is finding assets, finding notes, like you just talked about. The
yeah.
second is finding money to buy those notes. And no matter who you are, you're likely going to run out of your own money, or at
If you're
least the
finding
money that
enough
you have.
notes.
Yeah, if you're finding enough, or if
Yeah,
you may set a self-imposed limit on maybe your wife says you can only invest 50 grand. I don't know.
sure.
And then the third piece is asset management. So managing those notes, and that piece gets glossed over, in my opinion. But finding the notes is tough, can be tough. It's a very inefficient marketplace. I know you had a company that did provided this service as far as finding distressed notes, and so you're probably quite familiar with that, how that works and everything. But it can be through note brokers, it can be through Brett Berkey's company, paperstack.com. There are
Yeah,
some other online exchanges. And it's not like the stock market where you log on and click a button and you buy some stock. So
right.
it takes getting your name out there. It takes some work. It takes networking and just asking around. A lot of times a note fund will be closing and they have to sell off assets. And so personally, I haven't found much success with calling up banks, or and asking to buy one-off notes from
Yeah,
their books. But
pools.
there
They do
are
pools. Yeah,
what's that?
they do pools more often. I think we're having a
Exactly.
connection issue. I'll try and clean this up in
Yeah,
the
no
edit.
worries. Yeah, it's just a slight delay maybe, but it's a lot of times and it depends where how much capital you have to play with, of course. And so um but a lot of times you can find one or two note brokers who you kind of go back to if you can show that you actually follow through and will deliver and purchase. And it's a networking game. So
Yeah.
yeah, it is a
So
challenge though.
So what kind of notes are you looking for these funds? You mentioned, so you've got
Sure.
two funds. One I think is not open right now, and the other
Right.
one is still open. And so tell
Correct.
me a little bit about what kind of product you're looking for there, and like what, when you're evaluating these, what makes a good investment for you, or what are you looking for in the deal?
Absolutely. We buy first position mortgage notes only. And there are a few reasons for that. So we don't buy HELOCs, we don't buy second position mortgage notes. Some people love that space.
Yeah, my friend Mike Rosica
So we
is
have
all
two
about
funds. Okay. Yeah. I know like Josh Andrews and, Fuquan Balal, they've done
it.
well in the
Hmm.
second space, for example. But
Yeah,
um, there aren't as many notes, there aren't as many seconds out there. So that's one challenge with seconds. But we have two funds. One is a primarily non-performing note fund, and in that case, we primarily look for non-performing notes, meaning the borrower is not paying or they are at least 90 days behind. Okay, and
okay,
so um, our other fund, which is open to investors currently, is a performing note fund. It's a or reperforming, where the borrowers are caught up and they're paying monthly. It's a little more boring, so to speak. But right now, boring isn't necessarily a bad thing with all the craziness going on in the
yeah,
investment space in general,
yeah,
right? So just to kind of just for your listeners who are may be unfamiliar with what is a non-performing note, how does that
yeah.
investment
Talk about why would you want a bad loan?
Yeah, exactly. So I generally like to kind of compare or equate in a sense uh, a non-performing loan with a fix and flip property. So you're taking an asset that has distress. The borrower is not paying or hasn't paid in quite some time, and you're buying that at a discount. So to answer your question, you can get it at a much better price, right? Because the borrower's not paying. There's less
Yeah,
value in that asset. Well, that's opportunity as well if you know how to add value to that note. And there are many ways. We'll have to probably pause that part of the discussion. Many ways you can exit a non-performing note, but I like to equate it somewhat to a fix and flip property where you're adding value to that asset itself and you're
hmm,
exiting that asset through a sale or some other way. So you can exit through the borrower or through the property, but you can buy that at a discount and exit it through the sale of the note or the property at a higher price point. So you're actually adding value to the note by a modification or deed in lieu or different avenues. And you're adding value to that asset and selling that non-performing note as a performing note or as a property or some other way that you've added value to the asset. Whereas a performing note, on the other hand, which is what we buy for our integrity income fund. Performing notes are the borrower's paying. It's a cash flow play. So
mm,
there's not a lot of room to add value there. I'm not buying a performing note at a discount or as much of a discount because the borrowers are paying. So it has more value already. There's not as much opportunity for me as a note investor to add value to that note. And so that's what we purchase for our integrity income fund. And it's again slow, boring cash flow,
mm,
somewhat like a buy and hold rental property that's already stabilized, that is already rehabbed. It is what it is.
yeah,
But again, that's these mortgage notes have collateral as well, which is the real estate. So um, those are kind of that's just generally speaking non-performing notes versus performing. There's obviously a ton of gray area in this space, and I tend to say it depends as much as an attorney does these days. So not everything's black and white, but that's kind of like the basics, for your listeners who are unfamiliar with note investing as a whole.
sure. So when let's talk a little bit about then what you're looking for in the integrity fund. When you're out there shopping, do you have like geographic restrictions? Do you have size restrictions? And the other question I have is, up until very recently, rates have been so low for so long. How are you making any money or a return that's worth getting when I know my mortgage here is like 2.375 or something like that, and huge number of
Yeah.
folks out there have loans like that. How are you finding return there, and what kind of returns are you talking about?
Yeah, no, great questions. With our fund, we do have, generally speaking, we've purchased in probably 25 states.
Wow.
So we will generally buy across the country, but you will not find a lot of product in every state. So some of this is limited just by deal flow. But every state, this space is extremely state specific, particularly with regard to foreclosure laws and timelines and things. So we do have a buy box of states, but it's not 5 states,
Okay.
and it's broader than that. But we end up buying mostly in the Midwest and Southeast, where the numbers just tend to work better, and because is more product and maybe just the pricing works better. Price points for us, we stick to kind of the 25,000 to 100 and maybe
Wow.
$150,000 price range as far as principal balance goes. There's some reasons for that. One is that our income fund is fairly liquid, meaning we have a 12-month lockup period. And so that's somewhat rare in the note space. A lot of times you'll find 3 to 4 years where you've got to put your money as a passive investor. It's tied up for that long. Well, if I'm promising investors, hey, if you want your money out in 12 months, I have to be able to actually deliver on that, right? I can't just say that. And so
Yeah.
one way we are able to do that is by buying more notes that are smaller balance notes. So if Breck, if you invested, just hypothetical, if you invested in our fund and you put in 25,000 and then in 1 year you said I want my money back, well, if all of our notes were $500,000 notes, I don't have 25,000, 50,000, 75,000 to just
Yeah.
peel off. So with smaller balance notes in the portfolio, we have a little more flexibility and kind of liquidity there.
Okay.
Um, yeah. So yeah, hopefully that
Yeah, and
answered
then the
that.
other part of that question was how you're finding, like, what kind of returns you're
Right.
targeting because of just our compressed interest rates for so long.
Sure. Absolutely. So the space that we generally play in, these are 8 to 10% coupon rates, meaning the mortgage rate, the interest rate on the note itself is high.
Okay.
Um, and so the I likely won't see your mortgage trickle down to cross my desk.
Right.
Um, and so just these are maybe lower end properties, lower end borrowers as far as performance goes. Doesn't mean they're
Yeah.
bad people or anything,
Right.
but they don't have a strong credit history necessarily. And the fact that we have a lot of experience with foreclosures and different, modifications and working with distressed borrowers. That kind of allows for a comfort level regarding, if one of these notes does go non-performing, we know how to handle it. Um, so there's a little bit higher risk with that type borrower where the note is 8 to 10% on the note itself.
Right.
Um,
So
but we're
this has
still buying it.
actually been originated at 8 to 10%. It's not that you're buying
Yes,
that yield because you're getting a discount. It's
you
actually
got it.
was
That's
originated
right.
at that. Okay. And
And it
so,
may be a little bit lower. We'll buy a little bit lower interest rate notes, but we're still buying it at a discount, which creates that
okay.
yield you're alluding to.
Okay. All right. And so does that,
So
where does this was privately originated then generally? Is that how you're finding those?
it depends. So
Okay.
we've bought contracts for deed, which are technically a seller financed uh, contract,
Yeah.
and we'll buy seller finance notes, but that you got to be real careful there because you
Yeah.
don't know how it was originated. So we do wander into the the non-institutional space, if you will,
Yep.
but we do also buy institutional notes that maybe
Okay.
they have a 6 or 7% interest rate on it, but I'm still buying it at a discount. So, but to answer your question more pointedly, we
Yeah.
target a 12% yield
Oh,
right now on our performing slash reperforming notes. And let me just quickly define a reperforming note if I can.
sure. Please.
So a performing note is, look, this borrower's been paying from the beginning. Like honestly, most people are probably familiar with. You generally pay your mortgage, pay it on time, and So from the beginning, that note has been performing, and the borrower has 800 credit score. We're not going to get a 12% yield on a note like that. It
Right.
just doesn't happen.
Well, maybe
So,
next year. Next year's
right, yeah,
originations, you'll be
yeah,
getting
that's true.
12%.
If there are any happening
Right.
right now, but yeah, that's a good point. So reperforming it kind of, you can probably kind of figure it out. It was not performing at some point. So I've had success buying non-performing notes and then creating reperforming notes. There's certainly a higher risk of default on that than a true performing note that's been paying from the beginning. But a reperforming note, the borrower may have been unemployed or had medical bills, or something came up, divorce, something happened, and they stopped paying. Well, as a lender, we're able to work with that borrower and kind of get them back on track and get that note reperforming. So I can take a note that was non-performing. Now, I'm not just snapping my fingers. There's a lot of work to this,
Yeah.
but make it reperforming with the borrower's cooperation. And then if we have a track record of maybe 6 to 12 recent payments, on-time payments, that note can be considered reperforming. So there you can target 12, maybe even 15% yield, depending on what we're talking about. It's been harder to find those yields recently, trust me.
Yeah.
But because of that higher potential default risk, you can find that yield in this space that a lot of banks, they're not willing to write. I mean, lending criteria has gotten a lot more strict in the last few years. Banks don't even want to originate mortgages under 100 grand, generally speaking. So that does open
Yeah.
up opportunity for private loans, where it may be a self-employed borrower or someone that's has a good job, and there's opportunity for us to play in that, do well in that space.
Okay. So tell me a little bit about, I appreciate you walking us through, notes and how you think about that and the rates and all that. Why you guys? What's the edge there? What's the difference? Like,
Sure.
yeah, why should we invest with you?
Why are we special?
Yeah.
I'm just kidding.
I'm not.
There are a lot of options out there, and yeah, I'm personally invested in another note fund, two other note funds actually.
Okay.
Um, One of the reasons I would recommend our note fund is the 12-month lockup,
Yeah.
and so there's a lot of uncertainty out there right now in the market space, and maybe you have cash, or maybe you have a self-directed IRA or some type of account that's with a custodian, and you're not sure what to do right now.
Yeah.
Well, we pay 8% monthly payments. We aim to, I should say. There are no guarantees in this space, but
Yeah.
we aim to pay 8% monthly payments for a 12-month minimum time period. So other funds are often 3 to 4 years minimum, like I mentioned before. Ours
Okay.
is 1 year. So there's a good bit of, uh, I guess, flexibility there, with regard to that. And we're buying where there's plenty of equity, meaning there's the collateral value is relatively high. So this particular fund, the Integrity Income Fund, is a safe. Nothing is fully safe, but
Yeah.
relative to other investments and other asset classes, to me, it's a boring, safe, great play if you're looking for monthly cash flow with collateral. Also, our fund is across multiple states, so you're not investing in one project or one deal like a typical multifamily syndication or something like that. Your risk is actually spread across multiple borrowers, multiple situations, multiple states. So when you compare us to maybe again a multifamily syndication or self-storage syndication, oftentimes those projects are such high dollar amounts, all of your eggs are in one basket. So if that project goes well, great. But if it doesn't, it's not so great, right? So
Yeah.
you're mitigating your risk a little bit in that sense by spreading it across multiple situations, multiple states. And, again, this has been my primary focus for 4.5, 5 years now. It's my second fund. It's not my first fund. And we are a small shop. We like to deliver on customer service. And I also have an ownership stake in the loan servicing company that we like to use. And so there's some control there as well. And so it's a boutique small team. Customer service is there. You're not just a number lost in, one of 100,000 investors in some huge note fund. So those
Yeah.
are a few reasons. Ultimately, it comes down to trust. When you're a passive investor and you're handing your money over to someone else, you are letting go of some of that control. So
Yeah.
it ultimately comes down to whether you trust my track record and trust that I will do what I say I'm going to do, and not just me. I do have a team that helps me quite a bit.
Yeah. So it sounds like the risk's really mitigated by a few things. One is you're always first position, so there's always meat on that bone. What that,
Yeah.
I guess, hopefully, folks know what that means. If not, we'll try. I'll flesh that out a little bit
Hmm.
below. You're spread across multiple states, and you're spread into a number of smaller assets. So if you have default, it's not it's not a sort of a concentrated situation. So is
Exactly.
this an accredited investor only
It is.
investment? Okay.
Yeah, it is. We do sometimes sell partials or do different things with non-accredited investors, but frankly, I just made the business decision to stick with a 506c, and uh, and that's the reason I can talk fairly freely about the terms of the fund and everything. And so it is just for accredited investors only.
Okay. And what's your minimum?
25,000.
Okay.
Yep. And it's an evergreen fund, so we opened it, and at some point we will close the capital raising, uh, feature, if you will. We'll shut that off and we'll say we've raised enough capital. But right now it's open, and so there's not a set deadline per se.
Yeah.
Which but at some point we will shut that down here in the near future.
Okay. And so we talked about the minimum and target returns, and the lockup is 12 months. Tell me a little bit about the structure there. How are you compensated? How's your team
Yeah,
compensated?
it's a 2% asset management fee, and that's really it. I'm personally invested in the fund, and with my own money, and so that I get a little bit there with from my own investment. But no, it's primarily the asset management fee. Quite frankly, there's not quite as much work to be done on a performing note fund from an asset management standpoint. If you're buying well,
Yeah,
that's not to say there's no work. There's definitely work,
sure.
but that's the primary way that we're compensated through this fund.
Okay, and that's it, just 2%, and there's nothing else in there. Wow, that's
Right. I
really
mean,
interesting.
exactly. So we've got to make sure that we're targeting high enough yields to make that work.
Yeah,
Um, so again, this is more of a, even for me as an asset manager, as a fund manager,
yeah.
it's more of a monthly cash flow play. Um, who knows? One of the downsides with note investing, frankly, especially when we're buying performing notes, is they lose value over time. So as the
Hmm.
principal balance goes down,
Yeah,
generally speaking, that
yeah,
note is worth less in the future. We
yeah.
have it. We do have it structured where the manager would make any profits on the back end if magically we're able to sell these notes for a lot more than we're buying them at,
Hmm.
buying them for. But that's not the play here. It's not an upside play. It's not. I'm not banking on that at all for me personally.
Yeah. Cool. Well, awesome, Jamie. I appreciate you coming on here. If somebody wants to learn more about you and reach out, where should they find you online?
Yeah, LabradorLending.com. Um, and my email address is batemanjames@labradorlending.com. It's a little bit of a mouthful.
Yep.
And so, but we do have a free ebook, which is 74 pages. It really is chock full of information. And one of the things we go through, which I think might be helpful, is we have a blog post as well as a section in our ebook about this, but talks about, is note investing passive, and it talks about the kind of the spectrum, or um, how active note investors can work with passive note investors. And a lot of gurus will claim that note investing is passive, and you can put your feet up on the desk and just
Yeah.
chill out all day as a note investor.
Yeah.
Once you're managing more than a handful of notes, it's not passive. So,
Yeah.
I went on a little rant there, but yeah,
No, not at all.
labradorlending.com.
Yeah.
And we also have my podcast, which I'd like to just briefly plug. It's
Please.
not about notes in particular, but it's called From Adversity to Abundance, and we talk a lot about the human side of investing. Chris Seveny was on it as a guest, and we talk about overcoming adversity. And it is, we do talk about mortgage notes, but we talk about real estate and small business, and it's generally for investors and entrepreneurs. But I'm real passionate about it,
Yeah.
and I'd love to have your listeners take a listen to it. It's From Adversity to Abundance.
Well, I think everybody should be an entrepreneur and an investor. So they should go check that out. And we're going to have in the show notes links to all of this stuff, which will be at altreports.com/Labrador lending. And we'll put a link to your show and everything else in there. So
That's awesome. Thank you.
really appreciate you coming on here, Jamie. It's been awesome talking to you. Thank you for educating me on how it works over there. And if you've got questions for Jamie, find him there at labradorlending.com. And thanks for listening.
Thanks, Breck.